Hello, my name is Alan Ariana and I work with Junior Achievement. Today we'll be talking a little bit more about building and establishing credit. All right, to kick things off, what is credit? So, the definition that we have here is credit is the amount of financial trust extended to a person or a business by a lender, or it's otherwise considered a loan. All right, so there are a couple of pros and cons for credit. Some of the pros we have listed here is the opportunity to establish a good credit history. So, credit is all around us. It is important to start as early as you can building your credit history because, as we'll talk a little bit more about later, having a good credit history can contribute to having a high credit score. And this is essential when you decide to purchase your new home or buying your first car. So another pro that we have here is the ability to track expenditures. So, when you have something like cash, it's easy to forget about purchases that you've made. With credit, you have kind of that outline of the purchases that you've already made in the past, so you can refer to it previously, and this can be useful for just tracking personal budget, spending habits, things of that nature. And it also increases financial flexibility. So if you don't have cash with you right now on your person, you can use a credit card, borrow the money, and then pay it at the end of the month. Some of the cons that we have listed here for credit is that is not free money. It is money that is borrowed and money that needs to be repaid back. If you are late with your payment or cannot make that payment back, there will be penalties that you'll be facing. It can also lead to bankruptcy and or foreclosure if you miss too many payments or don't pay your bills at all. And this in turn will stay on your credit history, your credit file, and it will affect future loans that you want to approve for or any applications that you may submit that requires a credit check. Another con is that you may be charged interest if you decide not to pay your full amount, and these interests, these payments, these fees will end up occurring over time, and it will add up. So the importance of credit, we touched a little bit upon this earlier, but having a good credit score shows your willingness and ability to make payments. The higher the score, the more confidence a creditor will have that you will pay them back. So in essence, the purpose of a credit score, it shows your worthiness as a borrower, right? So whenever you're utilizing credit, you're borrowing money. And on a larger scale, that applies to mortgages, loans, whenever you're getting a car, and whenever you're trying to secure housing, right? And having a good credit history will give banks that confidence that they need to let them know that, hey, this person will pay back whatever they borrow. All right, so there are three main credit reporting agencies that provide credit information, and that is your Equifax, your Experian, and your TransUnion. So all three different credit reporting agencies have different methods for calculating your credit score, but in the end, it should be pretty similar to around the same number. And these all of these credit reporting agencies must provide customers with a free copy of their credit report upon request once every 12 months by law. So this will be penalty free. And lenders and creditors can also pull this report. All right, a little bit more about the FICO credit score. You may see this if you already have a credit card with a bank. If you have their app, you go there and their free calculation will usually show you your FICO credit score. So here we have different categories, which rank from very good to excellent to bad credit types. And this is the score from 300 to 720. So what goes into the FICO score calculation? So 10% is calculated for new credit. 10% is calculated for the types of credit cards used, the types of credit, the types of credit used. So this may include a credit card or a loan application or a mortgage. 15% is the length of the credit history. 30% is the amounts owed. And 35% is the payment history. So this is the one that really takes the most of the FICO score calculation. And although all things you should consider, your payment history and the amounts owed is the main big ones. All right, so for utilization, it's a good rule of thumb to only use up to 30% of your credit limit. If you use over 30%, you have the possibility of negatively impacting your credit score. So this means that if your credit card limit is 1,000, you should try and spend no more than 300. So this shows creditors that you're not desperate for credit lines and that you're able to properly manage your credit line. All right, so what builds a negative credit history? So making late payments, constantly exceeding your credit limit, applying for credit frequently. So let's say I open up one credit card this year. If I go ahead and open another one this year, I'm going to see a ding on my credit score. And having an account turned over to a collection agency. So this is if you're constantly missing payments, the business will report you and your account will be reported over to a collection agency. And this is a little bit harder to get rid of, so you want to avoid being reported to a collection agency as much as possible. Thank you. That is all that we have today.